So happy Saturday, everyone. It's Greg Dixon here, your fun investing host, and I'm here with Courtney Rogers from New York City. I'm in British Columbia so we have the continent covered, east to west. so, and um, and our topic today was how creative financing is changing the game for real estate investors. And Alden, who suggested this content, I was hoping he would jump on, but maybe something come up and he can't make it. Real estate people are pretty busy sometimes. And that we started this discussion years ago, really, about mortgage notes, and Courtney is the notes captain. So maybe you can explain a little bit how mortgage notes work.
Yes, thank you, Greg, and good to be here on this Saturday morning. Yeah, so uh, I I am an investor, and my company is East Coast Capital Holdings LLC. I'm also known as the Notes Captain. Um, so mortgage notes is basically an IOU. It's someone promising to pay, and the mortgage note basically states the terms in which the mortgage is going to be repaid. Um, we deal in mortgage notes um, because it's a way of, and I guess this is a perfect segue into creative financing. We can actually leverage um, a transaction um, with creative financing by what creative financing does. It allows someone who would maybe go into default. They see that maybe they're running into trouble, or they no longer want the payments, and they get uh, somebody involved like me and work out an arrangement where they can still, they don't get a foreclosure on their record. They're able to basically transfer the mortgage, uh, where I take over the payments. I make monthly payments to them. The mortgage still stays in their name. And one of the benefits of this creative financing is that the buyer gets to keep that low interest rate, to where they don't have to go get a 7 or 8% mortgage rate, which would naturally increase the payments. They can hold on to the same payments that the previous owner was making, and uh, structure it in a way that the seller is able to collect monthly payments while the buyer is in control of everything, but the seller still collects payments. Um, so that uh, transaction, while it's creative because you don't go through a traditional bank to do the transaction, it can take place a lot sooner. In most cases, that transaction could take maybe 30 to 60 days to complete traditionally, but with creative financing, um, we can get it done a lot faster. Um, Negotiate the terms, and once we come to an agreement, um, of course, we still want to do some due diligence with the um, title report, and to make sure everything is what it should be, and then the buyer takes over payments. So I think the traditional um, definition, it says structured deal using people, terms, and assets instead of traditional lending. Instead of a bank or a bank loan, where you usually put down 20%, you use the seller, private money, and flexible payment terms. So the terms are not predetermined, but it's a negotiation between the buyer and the seller, and you come to an agreement of what, whether it's going to be 20% down or 10% down or, any other number, percentage down, and then, whatever the monthly payments thereafter are going to be. Which, I'm sorry, go ahead.
No, I was wondering if we could run through a bit of a fictional scenario here. Let's say you have purchased a home for, let's say, $200,000, and which I don't think $200,000 goes very far in New York where you're at, or in Vancouver, but there are lots of places in North America where you can buy a home for 200,000. But so let's say you bought this home for 200,000, and you're going to do some owner financing. So how does that work?
So, so someone comes to me and they have this home that they're asking 200,000 for, and I'm guessing that they would have done some due diligence and checking what the market would be for that house in their area.
I'm thinking that you've already bought the home for 200,000 and somebody wants to buy it from you. So how would you structure the deal to allow that person who may not have really good credit? How would you use notes or owner financing in order to enable them to purchase the house from you?
Okay, so I'm the owner. Yeah. So
Yeah.
In that case, okay, I'm selling it for 200,000, and someone wants to buy it from me, and I'm going to give them owner finance. So in that case, I would try to find out why this person did not go through the conventional, or doesn't want to go through the conventional way, and maybe they couldn't qualify. Maybe there's something else. There's a foreclosure, whatever is going on, and so then as a part of the negotiation, because I'm not getting all my money up front, I can probably say, well, we can work a creative financing deal out where instead of the house being 200,000, I'm gonna raise the selling price to maybe 210,000, and I'm gonna require, instead of 20% down, you can give me 10% down, and so about $21,000 down, and then we can make monthly payments on the remaining balance. We're gonna amortize the remaining balance over 20, 30, 25 years, whatever number of years I feel comfortable with, and come up with a monthly payment. So this person can typically get access to the home a lot faster, instead of maybe two to 3 months, probably within 30 days. So at that point, I'm gonna put all the terms together and create a creative financing process, which is creating a mortgage for $210,000 minus the down payment, and then whatever monthly payments we come up with, whether it's a 20-year term or 25 or 30-year term. And so making it possible for, this person to realize their dream of owning
Yeah.
a home.
So would you be charging an interest rate on that?
Oh yes. So typically, the interest rate is going to be, it could be the market rate, or it could be a little bit higher, because there are more risks involved for the seller. Um, you're compensated, I guess, in some way for not getting all your money up front. And you can do that both by asking for a higher interest rate, higher than market interest rate, along with a higher selling price. Um, and you can offset it by, you know, making a longer term, instead of 30, maybe 35 years, if the payments are too high. But in general, yes, you would definitely, because that's how we make money, is by interest, a lot by the interest rates.
Yeah.
So we would definitely go at least market rate, if not a little bit higher.
Yeah. And I think because you're the bank, you can, it's up to you to decide how much leeway you have, because I guess there are times when maybe the buyer is struggling and they miss a payment or two, where in the case of a bank might be fairly quick to foreclose, but you might make an alternative arrangement, put those payments at the back end, and or they could come into some money and pay it off earlier, in which case you get your money back faster.
Yes, those both of those statements are true. Um, in the payment arrangement, the payment agreement, um, there will be consequences for late payments, just like in a traditional mortgage. And the the, uh, the buyer can lose their right, uh, just like with a bank. The banks might move more swiftly and according to the books, but you know, um, an investor might be a little bit more lenient, and as you mentioned, they might be more forgiving, and maybe add any missing or delinquent payments at the end. Um, doing a modification of the current mortgage, instead of just foreclosing. Um, so it depends. Some people, they they don't need all the money up front, and it's why they do the creative financing, but as a seller.
Yeah.
And so that each person decides what their money is worth, and how much they're willing to finance their money for. So
Yeah.
you can definitely be more flexible.
So I think the advantage to this is you help people get into a home where they would have a difficulty getting the money through a traditional bank. So that's a good thing. And for you, your risk is, in the worst case scenario, they default completely and you retain your property, and you hope that it's appreciated over that time.
Yeah. When uh, as investors, when you put your money out, or you lend it to somebody, or you do a creative financing deal where you're not getting all your money up front, you know you want to, you're still interested in that cash flow. And when that cash flow is interrupted, um, it's it could be an issue. So you try to get into deals where you are going to get constant cash flow, and minimize the risk of someone defaulting, by doing your due diligence with the buyer. um, Maybe not as in depth as the bank would, but you still want to know, how's this person going to pay me? Uh, they have a regular a job, how much they make, what percentage of, their monthly income is going to go towards this mortgage, and to get an idea of, you know, how likely this person uh, is to maybe default on on the mortgage. And sometimes you're you know you're able to um, work out to where you know this person is they're they have what it takes, and they the money, the cash flow is their cash flow is coming into a point that you feel comfortable with, and you go ahead and you make that deal.
So you basically have to do the same kind of due diligence that a bank would.
Yes, not maybe not as in depth, and that's another thing that um, buyers that use creative financing are attracted to. So whereas you know the bank has specific criteria that must be reached to make a determination.
Yeah.
Um, you know, an investor like me probably wouldn't have such strict requirements.
Yeah. So I think maybe I put you into an unusual situation because you're buying notes. You're not actually buying properties at the moment. So maybe you could explain what's different about buying a note on a property instead of buying the property itself.
Yeah. So buying when you're buying a note, you're buying the paper. You're not buying the property. You're buying uh, you're buying the mortgage, the mortgage note that secures the property. So you're not the homeowner. I'm not the homeowner, but I'm basically the bank for that homeowner. So they're still responsible for the home and everything that goes on in it, but they'll make their payments to me. So when I buy a note, um, I go through due diligence on the homeowner, um, similar to what I just explained, to make sure that they have a job, they have a ways of paying the mortgage, and to see what percentage of their income is actually going towards this mortgage, because I do want to have that cash flow and have you know a lower chance of maybe that mortgage defaulting. Um, there are always unforeseen circumstances, but yeah, I go through the same due diligence process, on the buyer. Uh, I do ask for W-2s, the pay stubs, sometimes job references, and to get a clearer picture of what their finances are. Um, and I do, look for payment history on the existing mortgage. Some of them are brand new. Maybe it's just been created. It's a new construction where an investor, they they bought the home, they fixed it up, and they they want to get their money back out. So they're selling this uh, um, mortgage note to get their money out of the house. And so, you know, I'm not buying a house. I'm just buying the paper that secures it.
Yeah, so I think there are a number of places where you can buy and sell notes, but one of the ideas, I think for many people, it's a hard idea to get their head around. Like, some of the notes will be sold by the banks themselves. Can you explain why a bank may sell a note and why they might sell it as a discount for less than what the property value is?
Yeah. So the way that, and this is what makes mortgage notes interesting to me. The banks structure mortgages um, to make money, and they structure it in a way that uh, for the first half of the mortgage, the 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 payments, um, they're going to be interest heavy to where you're going to be paying more in interest than on the principal. So in the case where somebody makes $1,000, $1,000 payment, which is principal and interest, um, so more than 500, more than half of that is going to go towards the interest um, than the principal, um, and a lot more, as a matter of fact, in the first 5 years. Um, so being being a bank, or as a mortgage note investor, I'm being the bank and modeling myself after the way the banks work, by you make money based on the interest rates, and so by having the going through the process of making sure that this person qualifies and they can actually make the payments. It makes it a good deal.
So you said something that I hadn't really considered before, is that the banks may they've got their money out of the first part of it and they'll let it go. So they'll take their money and then reinvest it somewhere else, use it for other loans. And we've got somebody else joining here. And Rodney. Hi, Rodney.
Hey there, guys.
Hey,
Hey, Rodney.
how'd the tournament go?
It went well.
Good.
Went good.
That's great.
So we've been Alden hasn't come on yet, so we've been talking about note investing and some creative investing things. Maybe you can introduce yourself. I don't know if your camera is going to work or it's going to.
Um, give me just a second. I'm pulling into the house.
Oh,
Just
okay.
thought I'll check.
Okay, there we go. We don't want to. We don't want to have any live issues happening. Yeah.
Yeah. So I kind of didn't answer your question there, Greg. I kind of lost track in what I was saying. But you were asking why do banks sell
Yeah.
mortgage notes, and they sell notes, and why they sell them at a discount. They sell notes sometimes to free up cash,
Yes.
and because, like I explained, the payments are interest laden in the first years. Um, the bank still makes money, so by selling at a discount, uh, they're not losing money. They're freeing up capital to do other stuff, and even if they had this mortgage for say 5 years, and it's better explained through an actual case study, but even if they had this mortgage for 5 years, let's say it's a 20-year mortgage, and they would have collected in 5 years, payments. So by selling it at a 10% discount, at the end of the day, they still make money. So they need like operating capital that sometimes, is tied up in these mortgage notes and other investments. So that's basically why they sell mortgage notes.
Yeah. Get some cash flow is good. And yeah. So where have you bought your notes?
So the best notes for me are bought from connections that I make at events. The DME, diversified mortgage experience, I think is the name of it, and some of the other ones. But it's good to network with other people that are in the business, whether they're contractors or other individuals, but also their online sites. And I'm trying to
PaperStack, is that one?
Yeah, PaperStack. That's the one I was trying to remember. Yeah, PaperStack is good. I definitely bought from PaperStack before. They have listings, from many states around the country.
Yes.
You can go on there, you look at notes, make offers, do your due diligence, and purchase everything online without ever seeing making personal contact with that person. Yeah. Hey, Rodney, good to see you.
I think for people. Hey there. Yeah, there we go. The gang's almost all back here. Anyway, I think for people who are new to notes, they don't realize. Courtney just mentioned going to conventions, and some of those are pretty large, with what, thousands of people at, other investors, or certainly hundreds.
Yeah,
and
definitely hundreds.
And of people who are buying and selling notes and doing other real estate investments and being fairly creative. It's kind of fun. Did you, Desi, the Notre University has had a boat cruise. Did you guys go on one of them, or have you gone on those yet?
I know they had something scheduled for this year, but I think they kind of pivoted, and instead of having the cruise, they actually had an online event, which was it last weekend or the weekend before?
Okay.
Yeah, but it was a networking event that it was the same kind of setting, where many professionals from many different backgrounds, presented on different topics relating to real estate.
Okay.
Yeah, so I don't think they had the cruise this year, but they did have the networking event.
Okay. So Rodney, maybe you can say where you're at and introduce yourself and what you're doing with notes. Did you freeze?
Probably. Yeah.
Yeah. Okay. Well, there we go. That's the challenge of doing things live, because you don't know what's quite going to happen. Yeah. So no, my experience is, Desi Arnett's phoned me, the head of the Note Investor University, and asked if I'd help with his Kartra account. And
sorry, guys, I'm having all kind of issues. I can't hear you guys.
Okay, can you hear me
so
now?
Let me log off and come back on.
Okay, all right. Anyway, so Desi called and asked me to help with his Kartra account, and I asked what he was doing. He says, "Well, we teach about mortgage notes." And I said, "What's that?" so, so I now know much more about than I did then. So it's kind of interesting, and it's a little bit in Canada. There are a lot of Canadian note investors, but they're mostly dealing with U.S. properties just because the way things are structured. I think in Canada, people are more likely to call themselves mortgage brokers instead. It's probably closer, but yeah.
Yeah. Yes, if I will, Greg, we spoke about creative financing. We spoke about the seller financing as part of creative financing, and subject to is where we also spoke about that briefly. Subject to is where the seller actually retains the mortgage. It stays in that person's name. The buyer takes over the payments. So that's another part of creative financing. There's also a lease option, which many people are familiar with, and that is where it's also called a rent to own, where you know you control the property with an option to buy later. So you lease the property, and you have the option to purchase it at a set price in the future. And a part of what makes this great is private money, as I also mentioned previously. You don't get the banks involved. It's all done, with private money. The investors who could be friends or or family members, and all they want is to finance, whatever at a certain interest rate. If they can, finance whatever deals are being made. Hard money loans, they're short-term loans from private lenders. Again, they could be family members, friends, or just professionals who just want to make money on lending. They're not interested in doing fix and flips and all of that. They just lend money as a ways to make money. They're usually shorter term deals where it could be used to, like a construction loan or a fix and flip, or that sort of thing.
Okay.
And then the last one I want to mention is partnerships or joint ventures. You bring the deal in, and someone else brings the money. So, like me as a professional, I have a deal, and which happens very frequently. I find a property or a mortgage that I want to buy on a property, and I do my due diligence. I find out this is a great deal for me, but I don't have the money right now. So in that case, I look for either a JV partner or a hypothecation partner where that person lends me the money to buy this mortgage note, and then we split the profits. So that's actually very common. So where someone has money to lend and they have minimal involvement, they don't have to do a whole lot of work. As a professional, I do all the work. I get the deal, I put it together, I borrow the money, and we split the profits. So that's mostly or a lot of what I do.
Yeah, because a lot of people don't want to, because there's a lot of moving parts as the holding the notes, the due diligence that we've talked about. So some people just want to get a return on their investments. I think Rodney, do you want to just explain where you're at and what kind of thing you do, and yeah, what kind of deals you put together with your notes?
Well, Courtney just outlined my whole game plan. Uh, I do the very exact thing, except towards the end. I don't partner. I don't split any of the proceeds. It's strictly the percentage of the of what they put into the deal. I put their money to work, and they only get a return on the amount of money that they put into the deal, and we keep it at that. No proceeds. So we're on the same track.
Same on track, yeah.
Yeah,
Okay.
Put their money to work.
Put their money to work. Yeah, yeah. Grow your money.
Grow.
So where just could you just say where you're at in the US at the moment?
Oh, I'm Rodney Madison from the noteexperience.com, and I reside in Maryland, but I look at notes all over the country. So any state that's favorable to lenders is where I prefer to invest in.
Yeah. So I was hoping Dr. Ivan would come on because he's doing something very similar to what you're doing, and also he's a representative from Florida.
Yeah, and I think he's doing a lot of development too with mobile homes.
Yeah.
As well. So he's very adaptable in this field of real estate investing.
And Alden, who proposed the topic for today, is in near Phoenix, Arizona, and that's their thing is manufactured homes, and they're have a major investment fund. They deal with a lot of notes. So.
Yeah, Alden's my buddy.
Yeah, I think we both did some business with Alden in the past. Yeah, mobile homes are definitely becoming very popular for housing now, and especially when the interest rates go up and it becomes more difficult to get financing. Mobile homes are a great source of home ownership for a lot of people. It makes sense to a lot of people, and I think Alden and his crew, they do a good job at leveraging that part of the real estate market.
Yeah, they have mobile mailbox money to. Anyway, I'm just going to say in Canada we have a bit of a housing crisis. There's not enough housing at the affordable level, and that's where the mobile homes and mini homes and those kinds of things come into it. Small manufactured homes just allow people, sort of everyday people, to be able to get into a home. And we were talking earlier, Rodney, is that the notes and various kind of creative financing helps people get into a home when maybe they would have trouble qualifying at a bank.
Absolutely. Yeah, I think Alden's group up there in Arizona are one of the largest mobile home providers in the country, or at least I know at least in Arizona, and they have a very unique program. I haven't come across it too many other opportunities like what they provide in the country. I think Ivan is doing something similar, but I think mailbox money they perfected their processes. So
yeah. So I've got a run. And just maybe briefly, I think both of you are looking for private lenders and hypothecation partners for your deals.
Yes, sir.
Yeah.
Well, I'm looking for anyone like Courtney indicated, anyone that has funds that are not working at their maximal potential. Say like if they have CDs, money markets, um, things that are earning less than 5%. I can provide anywhere from 8 to 10% returns on their investments. And again, they don't do anything. They don't have to. I take care of all the legwork behind the scenes to secure the note, do all the due diligence to make sure that it's a very passive return for them.
Oh, that's great. So, yeah, and you too, Courtney. I think you're offering something similar.
Yeah, I'm always looking for money partners. As Rodney mentioned, anyone that has money that is sub-performing, whether it's from an IRA or another investment fund that's not performing, or if it's cash from an inheritance, just sitting, by not investing it or getting subpar returns, your money doesn't do the best for you. So we provide a service that puts your money to work, where it's backed by collateral, which is real estate, and we all know that real estate has been a rock for the economy for years. So by having investment backed by real estate to where it's not just going to dissipate and blow away, you have an investment that's a lot stronger than most other investments out there, and the return is going to be contractual, not based on market rates that fluctuate, up and down. So, if you're looking for an above average return on your money, that is secured by real estate, we can help you secure a good investment that pays you long term, and we'll be more than happy to do a venture like that doesn't depend on market rates, but it's predictable. You can actually predict what your returns are going to be over a long period of time.
Well, that's great. And so if you're listening here, contact Courtney, contact Rodney, and see if this is for you. I'm late for an appointment, so I got to run. So and thank you both for coming and joining and sharing your insights here today.
All right.
Thank you, Greg.
For having us.
Okay, you're welcome. Happy Saturday.
Bye-bye.